Hey everybody, welcome to the Rochester Real Estate Show, joined today by Anthony Butera, the Anthony Butera Team. As always, Jason Mancuso here.
He's back.
He's been busy. All good.
Been busy.
All good. All good. We're going to dive right in. Hot topic on everybody's mind. Topic of the industry. Interest rates. Dun, dun, dun.
Yeah, interest rates. Fear factor.
Right.
What it's doing to the market. What's really happening in the market. Because what you hear on the news and what the reality is differs greatly. And I'm not going to just say, well, don't pay attention to national news, but even the local news, the content that they're putting out there, of course, it's fear factor, right? You get better ratings with the doom and gloom stories. You get more clicks. You get more viewers. You make more money. And the reality is we, at this point, because the market is changing, and it's changing at a pace that we haven't seen since it started changing towards the extreme seller's market that we were living in. And I say were because although there's still a lot of opportunity for sellers to take advantage of what is the tail end of a seller's market, right? So what's that mean? It means that, well, 12 months ago, the interest rates were just under 3% if you had good credits. Here we are a year later. They surpassed 6% for the first time in 14 years. And the Feds met yesterday, raised the rates 3/4 basis points. Doesn't mean it's going up 3/4 interest on mortgages. And yet they have to keep doing what they have to keep doing to control inflation. So they raise it. They're going to sit on it, see how the economy responds to it. And we're here to share how the real estate world responds to it. Well, let's start with the basics. The same buyer that was pre-qualified for $350,000 just 12 months ago may only be qualified for $260,000 today because the interest rate has more than doubled, right? So the doom and gloomers that are in the market, they're focusing on where the rates were and where they are now. And the same people that share that mindset are the same people that didn't want to get involved in multiple offers or overpay 12 months ago. Well, they can look back and reflect now and wish that they overpaid at an interest rate of under 3% compared to where it's at today. And yet, opportunity is here. Now, where's the opportunity? You can focus on that and say, oh, we missed the market. Well, no, now you can be more competitive because there's less competition, right? You can negotiate. Hey, you can have a home inspection. Remember those? Right.
Been a while. I mean, we're what? Let's call it 5 years of a seller's market at this point. I feel like 2017 was...
4 strong years,
4 strong,
1 transition.
17.
Yeah. One split year, and we hit a point that our market has never seen. Our average sales price increased more in the last 24 months than the 20 years prior. Mm-hmm. So we used to hang our hat on, well, we're not a sexy market, but we're stable. And all of a sudden we got sexy, right? So what's going to happen? Well, we're going to bring sexy back now. What's going to happen now is we're going to see median sales prices actually drop. And we talked about this earlier today during our team meeting. It was like, well, how? Why? Well, here's why. When you have 15 offers or 30 offers or 50 offers on a house, buyers were willing to stretch their emotional desires to obtain that house because their interest rate was 2.9%.
So they had buying power.
They had buying power.
A huge amount of buying power, unprecedented, like historical level of buying power with a 2.8, 3, whatever. Mm-hmm. It's just historically low and unheard of.
It's crazy. And yet, here's the opportunity. There's never been a 10-year cycle historically where the values have not increased dramatically and where the interest rate hasn't fluctuated from in the past. Now, it never dipped lower than like a 6%, right? And yet we've been living in a 3% or less world. And guess it's going to go up and it's going to go down. I don't want anybody to buy a house if they don't intend on staying in that house for enough time for that home to appreciate, right? So if I were to ask the average consumer, listen, I know you guys want to buy a house. How long do you think you're going to be here? A lot of people say, well, this is going to be our forever home. Well, I've owned 4 forever homes, right? And things change. And yet I know you're going in with the intent of probably being there 5 years, 10 years, right? And as long as you're not buying and having to sell in that next 2-3 years, you're going to be protected. We talked about worst case scenarios earlier today, Jason. So give me a worst case scenario.
So, I mean, I think, the worst case scenario of the market that's been and is now changing moving forward is that, you bought something, say, in the last 2 years, 2020 and 2021. Okay, because 2022 this year, things have started to come off that peak and cool down, let's call it. So you purchased in that time frame when there's just, yes, you've had a low interest rate, but there's just been these extreme examples of bidding wars, and you're paying, you referred to the emotional side of it, right, in terms of the emotional premium that was involved to win that offer situation when you're going against, 10, 20, 30, 50 offers in some crazy cases, right?
Yep.
So, you take that delta of what would be, call it a normal fair market value, and what's been happening in the last couple of years is tack on that premium on top of that. If you have to sell, you said cyclical markets, right? If you have to sell in what is, just call it, the opposite of the peak of the market that we've been in the opposite condition, in that cycle. And that may not be like, everything hit the fan and total recession. But it's just, again, markets are cyclical. And then that cycle, there's the upside and the downside. If you have to sell in that downward turn, you may lose that premium, the value of your home, and you paid that premium, it may not be worth that.
Yeah.
So the example is, let's just say 5 years ago, a home would have sold for $200,000. 2020, 2021, it lists for $250 or whatever. It may even list for $225. In a not obnoxious scenario, sells for $250. Maybe this home sold for $300. Okay. The $250 to $300 is the premium I'm talking about. If you have to sell in 2 years or in the 2-year period coming up, which predictions are is going to be that downturn type of thing, the house may only sell for $250, and you got a mortgage based on $300. You could be cutting a check.
Yep.
Now keep in mind, $250 is still more than $200 of what it was 5 years ago.
Yeah.
So these conversations that we've had to have of like, again, tough to predict the future, tough to predict your family life or situations, happen, right? But don't buy a house if you just have a definitive 18-month plan and I'm out of here.
Yeah.
That's what we've been talking about. And, for the most part, everybody are making sound decisions in terms of, okay, planning accordingly from a timing standpoint. When these logistical things happen or, death, divorce, marriage, babies, all that stuff, when life happens and you have to sell in an unexpected time period, what could happen could be negative. Yeah.
Sure. And if you're 80 years old and you potentially have some health issues, don't buy a house if you're looking for an appreciation, right? And let's just say you bought for $300 and in 6 months it sells for $250, right? Well, number one, you're probably going to be protected because if you got a house the last few years, you probably put 20% or more down because it's been that competitive, right? And if you absolutely had to sell, right? Let's just say it was a divorce situation, court order, they had to sell the property. You're going to take a hit, right? There's risk with everything. And if you don't have to sell, look at what people are paying for rent.
Well, yeah.
Right? You could rent that same house out if you didn't have to sell it. So you have opportunity there, right? And if you went into purchasing a home thinking that everything was just going to be on the up and up till the end, right? You shouldn't have bought a house. But let's talk about what your alternatives are. Show me a positive alternative outside of home ownership.
Well, and especially, you know, a catalyst to the market that we've been in has been what you just mentioned in terms of rental rates rising too. Mm-hmm. So like, you know, the old $1,000 a month turned into $1,500. It's real money.
Yeah.
And especially in a market where we have lower price points, we're still, you know, in some cases, a couple $100,000 under the national average.
Yep.
In the suburbs of Rochester, right?
Yep.
And, you know, you could still justify that your monthly payment is going to be less than what you're going to rent that same home for.
Yeah.
Even now, even with higher interest rates. So, yeah, I think it's worth addressing. This isn't a pitch, but it's just like, you know, if you're waiting for the right market, there's never going to be just a total, like, you know, favoritism to one side.
Nope.
Right? In a seller's market, you know, it's been great for sellers, but most sellers also have to buy.
Yep.
Whether they're relocating or staying local. And, you know, yeah, okay, you get a good interest rate in the past couple of years, but it's been tough to buy.
Here's the opportunity, right? This was a data point that I pulled and was like, that's easy to relay. That's easy to translate, where 99.9% of the people could digest the information and settle with it. Going back 25 years, right? National average going back 25 years, the value of homes have increased on average 5% per year going back 25 years. So what does that mean? If it increased 5%, and listen, it may decrease the next 2 years, and then increase 15% the year after, right? So we're talking about a longer period of time. If you are in that same home for 10 years, the averages tell us that your equity position is going to go up 50%. 20 years, it may double. We've watched homes double in value in the last 5 years. We literally have sold homes for clients 5 years after they purchased for double it, without doing much to that house, right? Making it look good on photo day and presenting it in the right light. So
the key part that people need to understand with the news headlines and the data is, for the most part, these are going to be year-over-year comparisons. So to say that the market, you know, increases 5% per year compared to the last, or in these cases, you know, what you're going to start hearing in the news, especially as 2022 wraps up, is, you know, 2022 real estate market down 20% in transactions, median sales price, as you mentioned, you know, down 5%, down 11%. That's compared to last year.
Yeah.
Last year was an all-time high.
Yeah.
The year before that, you know, and you know, this is where it adds up, right? Like, let's just look at 2021. Increased double-digit percentages based off the year prior, which also had a double-digit percentage increase based off the year prior, which also had, you know, significant growth too. So, you know, we've been riding the roller coaster up. We don't have the crystal ball to know that it's just going to be the straight dive down.
Yeah.
And optimistically, you know, it should just be a little, you know, like the kids ride at Seabreeze and Darien Lake, and not the you know, the Superman or whatever.
Yeah. So worst case, well, let's just say worst case, something happens that's never happened in our market ever before.
Sure.
In 10 years, you have to sell your home, and it did not increase in value. What the hell? How did this happen? This never happened before. All right, well, let's work through this. You have 10 years worth of equity payments into that property. You've benefited from 10 years of tax deductions because you owned a property and you didn't rent a property. Worst case scenario, if that happened, which never has, you're still in a way better position.
And keep in mind, you're coming from that worst case scenario and painting a picture of something that just has never happened. We're not talking about 2 years.
Nope. But this is
We're
for you
talking 10.
This is for you half, you know, glass half full, half empty,
right?
Not half full, right? So find solace in that.
Yeah, and you know, heading into, you know, a shifting market. You know, say if we surpass balance and go to a buyer's market.
Yep.
Okay, you know, here's the give and take here. yeah, buyer's market, you got less competition, you get a home inspection, you don't have to go against bidding wars.
Yeah.
Maybe you're even under list price.
At
a higher interest rate now, right? So, weighing the pros and cons, sure, there could be an argument where that's a win for a lot of people in comparison to the past couple of years of no home inspections. Throw the highest number you can out there and hope that it sticks at a much lower interest rate.
It's interesting because and it just clicked now as we're talking about this, my same message I'm delivering to nervous real estate agents in our company or on our team, I can deliver to the consumers.
Sure.
And that is, if you got into real estate thinking that it would be the same market your entire career, you didn't plan on being in real estate long. If you purchase a home thinking that it was going to be the same market throughout the life of your ownership of that home, you shouldn't have bought a home.
Well, I love that logic because you can spin that around too, to where you're not going to buy a house with the presumption that it's going to go down in value. Mm-hmm. If you're buying in a down market, right? Yeah. So, I mean, you have to ride the roller coaster essentially, right?
And 85% of sellers also turn into buyers. So if you're taking a hit, you're going to take that advantage on the flip side on that next purchase, right? So in most cases, it washes.
Yeah, and unless we have just a true balanced market, meaning there's one, it's proportionate. There's one buyer for every home on the market.
Yep.
Then this isn't going to be the case. But otherwise, it's going to be a give and take type of example or type of situation. And, with the interest rates being what they are right now, above 6%, and, listen, God, I hope it doesn't go to 7. I hope it doesn't go to 8. I hope it doesn't go to 9. I hope it doesn't go to 15 like our parents had back in the 80s.
Yep.
We don't know.
We don't.
It would be foolish to sit here at this point and say there's no way it goes to 7 because, 4 months ago we were optimistic, or, a little longer, 6 months ago at this point, we were cautiously optimistic that it wouldn't go to 6.
Yeah. But everything's relative because I talked to my parents about those times when they had 17% in 1983. That was the interest rate. Well, during that same time period, they had $5,000 in the bank in a CD that multiplied multiple times over, right? Yeah, so there's equalizers to every fear factor.
And the mortgage loan amount was, $40,000, right?
Yeah, all relative.
Which case in point to the, short/long-term value and appreciation of real estate.
Yeah.
It's a, don't get us wrong, it's a topic that, causes stress.
Sure.
Just started talking about interest rates because that's, really the topic of the moment in the industry.
Because the news,
fuel and everything.
The news causes stress.
Sure.
I was waking up and turning on 5 a.m., right? Turning on channel 13, and I would sit there and wait for sports to come on, and I had to sit there and plow through mass shootings, right? It's bad news. Ratings are delivered through bad news, right?
So true. I stopped watching those. Yeah. I used to watch all the time. After COVID,
and
turn it off, get the headlines, and digest from there.
Now you just live recklessly and create your own bad news. I love it. That's how you do it.
YOLO, baby. All right, that's a wrap for this one. Thanks for tuning in, Rochester Real Estate Show. Check us out, AnthonyButeraTeam.com. Thanks, guys.
Thank you.